Good afternoon and welcome to BizTech's Asian Midday Market Watch. Our guest today is Gabriel Yap, Executive Chairman of GCP Global. Gabriel, it's always great to have you on the show on a Friday when you're super casual.
Yes, you're just chasing some tenants for payments.
Now let's take a look and see how markets are performing before you come back and get your insights. Now we're going to start with crypto markets. Bitcoin is at 44,970. It's down 1.26%. Ethereum is at 3,096. It's down 2.51%. Now over across to regional equity markets, we've got Bursa Malaysia, which is at 1,501.63. It's down 0.02%. The SGX is at 3,159.77. It's down 0.72%. Now the Nikkei is at 28,030. It's up 0.06%. The Shanghai Composite is at 3,515.76. It's down 0.25%. The Hang Seng is at 26,331.89. It's down 0.7%. The ASX 200 is up 0.47% at 7,626. And rounding up the numbers, we've got the Kospi, which is down 1.36% at 3,164.69. Gabriel, what's your view on how markets have performed this morning?
Well, I think it's still a market basically that's demarcating between the developed markets and the developing markets. Within the developed markets, the US is actually poised to continue to go higher. As you see in the latest results that came in, about 72% of S&P companies have reported on their earnings. And I think based on that, the EPS has been upgraded even further. At the beginning of the year, we were talking about 193 EPS on the S&P 500. Now, most analysts are and have upgraded the EPS forecast for this year up to as high as 200, 205, which if you look at the mean average for 2022 forecast, they're even looking at a higher EPS, notwithstanding a highly likely tax bill to be passed, which may then increase the corporate tax in the US and therefore impede EPS growth.
Yeah, one of the things that has been a theme when people talk about is the market peaked already, is the fact that on the flip side of the equation, all these companies are actually reporting stellar earnings.
That's a fabulous verb to use, Prime. I think from stellar, superlative, stupendous, you heard it, in this last set of earnings. In fact, since third quarter last year, that means 3Q last year, 4Q last year, 1Q this year, and 2Q this year, the earnings that's been coming through is actually pushing the EPS growth this year compared to last year by as much as 72% growth. And looking to next year, people are still looking at a higher upgrade. As I've mentioned earlier, the EPS is looking at like 210 to 220 for next year, which means that the S&P, which currently stands at the valuation at 22.7, yes, you may say it's a 5-year high, but don't forget that based on the 5-year average, the 10-year bond yield is basically close to the 5-year low. So if you believe that this inverse relationship holds, then you will see, and you will find it very difficult to say that S&P, even though at 22.7 times, is on the high side, but it's difficult to justify that it is expensive.
Yeah. Now I want to talk, zoom closer to home on 3 REITs that have recently announced acquisitions to grow their distribution per unit. So you have basically Keppel Pacific REIT, Cromwell European REIT, and Keppel DC REIT. What are your thoughts on these 3 REITs, Gabriel?
Right. I think let's take one and go in detail for each of them. I think for Keppel Pacific, the acquisition actually in Colorado and Nashville, and you can see that this is actually moving inland. You can see that essentially these 2 buildings actually yield close to about 8%, compared to the likes of, for example, the portfolio within NOI, where they actually have like buildings like the Exchange at New Jersey, and those that's very close to Washington. Now, those are yielding at less than 5%. So you can see that the likes of Keppel is actually adding into the portfolio higher yield buildings in the hope that DPU will continue to be enhanced further. The downside thing is that if the work from home continues, then of course the likes of fringe places like Nashville, Tennessee, Oklahoma, within the US would actually be able to catch up in ratings compared to, say, the mega valuations that we are seeing in, say, San Francisco, New York, as well as actually Texas. Now, moving on to the second one, that's actually Cromwell. Now, Cromwell actually went into industrial logistics into the likes of Slovakia as well as Czech Republic. Now, in this case, again, it is a case where they're chasing for higher yields. Like the likes of Slovakia and Czech, they're getting yields of close to 7% for logistics assets. This helped their blended overall DPU to be up. But again, the questionability of how good these assets are and whether they are overpaid for these assets come into questions. Now, the one that I'm most optimistic, of course, is the one by Keppel DC. In our last REIT class last week, we told our students that, look, Keppel DC share price, which is one of our favorite, have actually inched downwards from 3 to 257, right? And then they actually embarked on this acquisition, the very first of its kind since the new CEO came into being, and this acquisition in Shanghai is actually really good. It's a data center, 7.8% yield, and at an 8% discount to valuations is as good as you can get. And more importantly, they have an ROFR, or what we call rights of first refusal, for the remaining 5 data centers within the portfolio. So this means that for earnings clarity for Keppel DC is nice and well.
Now, you also talked about earlier this week, ESR Cayman, which is headquartered in Hong Kong, announcing their ARA Asset Management acquisition for $5.2 billion US dollars. Now, the merger of these two basically creates the third largest listed REIT in the world. What are your thoughts on this deal?
I was interviewed for the Business Times in Singapore, and I've actually shared that it is a trend already that REIT managers, be it Blackstone, Brookfield, or ESR, has to get bigger because the mandates for managing each of this portfolio are getting bigger. It's no longer basically just multiple one particular jurisdiction, but it's actually multiple jurisdiction now, multi-platform, cross-section kind of assets for managers to actually manage. So for example, within ESR, they are not only just looking at managing more logistic assets, they're looking at logistics, come data centers, as well as come industrial, high-tech, warehouse kind of park kind of businesses. So that expansion is actually good. The only thing, of course, is that in any acquisitions, it is clear that the acquiring share price will go up. In this case, ARA is not listed, so you don't see the share price move, but the acquirer share price will normally take a hit, which in this case was predicted, and we were correct. The ESR share price actually took a hit of about 5% upon the announcement of the deal. Now, upon consummation and long-term processing of this deal, then one has to look at basically how does the overall portfolio of the merged entity lead to higher DPU at the ESR group level. And this is something that most analysts, that includes myself as investors, are very interested to look going forward, particularly when the share price has taken off a little fraud, at the $30 level.
Gabriel, as always, thank you very much for coming on the show and for your insights.
Thanks, Brian. Have a good weekend.
Now, we've been speaking to Gabriel Yap, Executive Chairman of GCP Global, on BizTech's Asian Midday Market Watch. I'm Brian Fernandez. Please check out our Facebook and LinkedIn pages, as well as our website, www.biztech.asia. Please like and subscribe our various platforms. Thanks for tuning in.